Hello students, in this lecture we will be looking at the different methods for calculation of GDP, that is income method, production method, expenditure method, and then we'll be looking at the difference between nominal versus real GDP. So let us start. So we should know that there is a cycle that production generates income, income is used for expenditure, and expenditure in turn leads to further production. Suppose if this is machine X which is being produced. Okay, this machine X is produced. Now there will be some workers who will be involved in production of this machine. Now these workers will get their salary. Okay, so this will be their income. Now these workers will spend it. They will spend it on something. So this will be their expenditure. And what they will spend it? They will buy some products from it. They will buy some products from it. So they will buy some products, say machine X they are buying. So a cycle is formed in which income is leading to expenditure, expenditure is leading to production or products, or production is leading to income. Okay, so a cycle is there of income, expenditure and production. So here you can see income is leading to expenditure. This expenditure is leading to products. And these products is again leading to income. So in these three ways you can calculate the GDP: by income method, by expenditure method, and by products method or by production method. So in income method you will have to sum total of all the incomes which are involved, that is land, labor, capital and enterprise. So the sum of income by all these factors of production will be the GDP by income method. So what will be the income on land? So income on land will be rent. Income on labor will be wages. Okay. So this is how you will have to calculate the GDP, the income on all the factors of production. Similarly, for expenditure method, what you will do is that you will sum total of all the expenditure involved, that is expenditure, that is the expenditure by private households, that is consumption, plus government expenditure is G, I is private investment, plus NX, that is net exports. So this net exports is nothing but exports minus imports. So this is the GDP by expenditure method, how much is getting spent. This is the GDP by expenditure method. In case of GDP by production method, we'll have to take the value of final goods and services, final goods and services, of final goods and services involved. Okay. So this is how you will have to calculate GDP in case of production method. So these are the three ways. We'll be seeing them one by one: GDP by income method, GDP by expenditure method, and GDP by production method. And I hope this is clear to you that income is leading to expenditure, which is leading to production, which is further leading to income. This is the cycle. So these three phases of circular flow of national income, these are the three phases. So one is output / production method or value added method. This is also called value added method. And this green color means this is used by Government of India to calculate the GDP. This is one of the ways that is used by Government of India to calculate our GDP. Then by income method. So again, a green tick means this is used by Government of India to calculate our GDP. And expenditure method, now this X will mean this is not used by Government of India to calculate GDP. So in exams, they may ask you which of the following methods are used by government to calculate the GDP or to not calculate the GDP. So if the question is not, then the answer would be C, that expenditure method is not used by Government of India to calculate the GDP. Please remember this. Okay. So now let us see them one by one. What are the different methods involved? So this is the expenditure method. In this, there will be consumption plus private investment plus government plus net export. Net exports means export minus import. Then income method, we have wages plus rental rent on capital plus profit. Production method, we have final values of goods and services and intermediate cost. These are the three ways. Okay, just remember that this is the final value of all goods and services, not any intermediate goods and services. And if there are any kind of intermediate costs which are involved, okay, suppose if a transportation cost is involved, then we will count it if any intermediate kind of cost is there. But a simple definition is just we take final value of all goods and services. This is the general definition which is taken, that you just take final value of all goods and services. Okay, intermediate cost we just don't write in many books. You will not see that it is written because at times it creates confusion. So we will be just seeing the final value of all goods and services in production method. All right, I hope this is clear. So GDP by income method, let us see. According to this method, national income is estimating by adding incomes earned from all factors of production for their factor services during a year. This is very important, during a year. So what are the 4 factors of production? That is land, labor, capital, and enterprise. Okay. So the income earned by these 4 factors of production is taken, and then you add indirect taxes and you subtract subsidies. This is how you will have to calculate the GDP by income method. We will be seeing this, okay, in the next slide. But before this, you should know about one thing, that is NFIA, that is net factor income from abroad. Net factor income from abroad. You should know about this. Now this NFIA, net factor income from abroad, is nothing but income earned by Indians, income of Indians in foreign country. I'm just writing short. So income of Indians in foreign country minus income of foreigners in India. So this is your net factor income from abroad, a very important term. Please remember this. This is your net factor income from abroad, income by Indians in foreign country. Okay, so income of Indians in foreign country minus income of foreigners in India. This is your NFIA. This is what it has been written. This is, I have written it mathematically. This is mathematically. A very important thing. Please remember it. So now let us see the income method. So 4 factors of production we have are land, labor, capital, and enterprise. From this, you will get, from land you are getting rent, from labor you are getting wages, from capital you are getting interest, and from enterprise you are getting profit. So this will lead to your national income, or one may say net national income. Now if you add depreciation to it, this net becomes gross. And if you subtract NFIA from this national becomes domestic. Okay. So this is how you mathematically derive it. Rent plus wages plus interest plus profit. This was your national income or net national income. You added depreciation. So this became gross. From net it became gross after, and you subtracted the NFIA. So from national it became domestic. So this will give you GDP at factor cost. Please remember, this is gross domestic product or gross domestic income at factor cost. Now you will be adding taxes and subtracting subsidy. So this will give you GDP at market price. So this is how the GDP is calculated. I hope this is clear. A very interesting diagram, at the same time a very simple one. 4 factors of production: land, labor, capital, enterprise. From this you will get rent, wages, interest, profit. Add depreciation, so it becomes gross, and add and subtract NFIA, so it becomes domestic. Instead of national, it will become domestic. This is gross domestic product at factor cost, and then we have plus taxes minus subsidies. Okay, so now let us look at expenditure method. Expenditure approach is converse of income approach. So it is converse of income approach, as rather than income, it begins with the money spent on goods and services. So now you are calculating the money that you are spending on goods and services, how much you are spending. Okay, this measures the total expenditure incurred by all entities on goods and services within the domestic boundaries of a country, or within the economic territory, one may say. Okay, again this is calculated on yearly basis. So mathematically, GDP as per expenditure method would be, mathematically it would be C plus I plus G plus exports minus imports. That is, this is known as net exports. Okay. C plus I plus G plus NX. This is known as GDP by expenditure method. Okay, where C is consumption expenditure, that is consumers spend money. So whenever they spend money, they buy something, that is C. I is investment, okay, expenditure, that is business spending money. G is government expenditure, that is government spends some money to build road, railway, etc. if it is spending some money or any kind of investment. And then exports minus imports, that is EX minus IM. Now, why is exports minus imports? Let us discuss this so that you will understand. See, suppose these goods are getting produced in our country. This is our country, and this good was produced here. But now this is exported. Now this is exported to some country B. Okay, now this is exported to some country B, like this. All right. So even if this is exported here, the good was produced in this country A, and this is country B. So these goods were produced in country A and sent to country B. Okay, so that is why it will be included in the GDP of country A, even though it was exported from A to B, but it should be included because it was produced in country A. That is what we learn about GDP. What is produced within the economic territory, that is added in your GDP. Whether you export it or not, it is a different thing. But if it is produced in your own economic territory, then it will be added to your GDP. Similarly, suppose if this red color good is produced in country B and this is imported to country A. This is imported, the red color I am using for import. Now, if this is imported to country A, then in that case, what will happen? It is getting produced in country B, not in country A. So we will have to subtract that import that is taking place. So you add the export, but you subtract the imports. Okay, because you will be spending some amount for imports also, na? You will be spending some amount for imports. So that expenditure you will not calculate what you have spent for imports. You will just calculate how much you got from export. How much you got from export, this you will calculate, but not the imports. Imports you will have to subtract because that is getting produced in some other country. Okay, in that economic territory. It is getting produced in the economic territory of other country. Please remember this. Okay. So GDP by production method. Now let us look at the last one. So the production approach essentially is the reverse of expenditure method. So in expenditure method, we were seeing the expenditure. Now we'll be seeing the products, how much is produced. Instead of measuring input costs, so we are not measuring input costs that contribute to economic activity, the production approach estimates the total value of economic output. So what is the total value of economic and deducts the cost of intermediate goods that are consumed in the process. So you will have to deduct the intermediate cost of the goods that are consumed. Only you have to estimate the total value of final economic output. The final economic output. Okay. This is wants to say this method finished goods and services value are added together. That gives the total production of the country. So only the finished goods and services value will be added together in this method. That will give you the value of finished goods and services value. It will not calculate intermediate product value, only final goods because of overlapping value. This we have studied in the previous lecture, what overlapping is all about. Let me just tell you again in brief. Suppose this is a cotton farmer. He is producing some cotton. Now these cottons will make some yarn. From this yarn, you will make some fabric. And from this fabric, you will make some shirt. So you will just calculate the price of this shirt. Suppose this is rupees 200. You will not add, suppose this is of 10 rupees, this is of 20 rupees, and this is of say 40 rupees. So you will not add this 10, 20 or 40 in your GDP calculation. Because if you are adding this 10 rupee will be added in the case of cotton, in the case of yarn, in the case of fabric, and in the case of shirt also. So this 10 rupee will be calculated along the chain every time if you account it. Because in case of yarn also, the producer of yarn will include the value of cotton at which he has brought the cotton. In case of fabric also, if this is the fabric, this stage is the fabric stage. So in case of this fabric, he will include the cost of the cotton, the production cost of the cotton. So it is getting in the case of t-shirt also, whichever. So it is getting counted again and again. So you just calculate the value of final goods and services which are produced. Please remember this. Okay, and exclude intermediate one. This is the production method GDP. Okay, now let us look at the gross national product, what it is all about. Okay, now gross national product is the market value of final goods and services produced in a year by residents of the country within the domestic territory as well as abroad. So it should be better, it should be citizens, not residents. It should be citizens. The citizens of the country within the domestic. GNP is the value of goods and services that the country's citizens, as I was saying, it should be citizen, produce regardless of their location. So if any Indian is living in say USA or in some Arab countries such as UAE, okay, or say in South Africa or Australia, if they are producing something or if they are earning something, that will be calculated in the GNP of India. But if any Indian is earning something in USA, it will not be calculated in GDP. In GDP it will not, but in case of gross national product, you take the earnings of all the citizens of a country wherever they are located. Please remember this. So the formula is GNP is equals to GDP plus net factor income from abroad. Or GNP can get calculated as C plus I plus G plus net exports NX plus NFIA, because this is nothing but your GDP. Okay, so I hope this is clear. So these are the ways in which you calculate GNP. You add net factor income from abroad in your GDP, and net factor income from abroad is what we have already discussed. Net factor income from abroad is nothing but income of Indians in foreign land minus income of foreigners. This is minus sign, minus income of foreigners in India. This is your NFIA, net factor income from abroad. Please remember this. Okay, this is how you calculate GNP from GDP data. This is NFIA. All right. Now let us look at gross national income, GNI. This is again a very interesting concept. In case of GNI, what is happening is that is a measurement of country's income. So it is again a measurement of country's income. It includes all incomes earned by country's residents, business and earnings from foreign sources. Please remember this, that whatever the residents, business and the income which is coming from foreign sources, even if that income is generated in some other country, but if it is coming from some foreign sources to the country, to the domestic country, it is included in GNI. Income is defined as all employee compensation plus investment profit. So what it wants to say is that this is the chart in which you will understand. So in case of calculating GDP, you will just calculate what is happening inside the economic territory of this country. Okay, what is happening in the economic territory of this country. In case of GNI, what will happen is that suppose from this country, a plant was set up here for some kind of manufacturing. So whatever the profit is coming back from this plant to this country, okay, so from whatever profit is coming back to this country, the profit coming back will be part of your GNI. So all the incomes earned by country's resident, business and earnings from foreign sources, okay, that flows back to a country. This is important, that all the income that is flowing back to the country, that is flowing back to the country is part of GNI. So in case of GNP or GDP, what it will be, that in case of GDP, it will be all the income which is taking place in the domestic territory. In case of GNP, it will be what? The income of all the residents wherever it is taking place. But in case of GNI, what will happen is that if certain profit you are getting, okay, if you have made any investment and from that investment, if it is coming back, okay, then it will be included. So in case of GNI, you will also include investments that you have made. That investment is coming back, then it is included. I hope this is clear to you. Let us see another. GNI also includes any product taxes not already counted minus subsidies. It also counts the income by citizens of a country if it is remitted back to the country. So if a citizen is, suppose if a citizen is earning 50,000 rupees in India, and if he is spending 20,000 in India, and if he is remitting back 30,000 to India, to his parent country, if he is remitting back, this is remitted. This is remitted. This is the remittance or the remitted money that he will send. So this remitted money will be included in case of GNI. This will be calculated in case of GNI, that he is sending it back. Please remember this. So this will be included in case of GNI. Similarly, any income that comes from any kind of investment, okay, to a country, and expenditure made by foreigners in the country. So if foreigner is making any expenditure in the country, that is also included in GNI. So GNI is a broad concept, you can say. Okay. So let us see the relationship between GNI, GDP and GNP. So GDP is calculated as C plus I plus G plus NX, that is net exports minus imports. Okay, exports minus imports. This is X. So GNI uses GDP and two different income circumstances. Income from citizens and business earned abroad is A. If income from citizens and business earned abroad is A, and income remitted by foreigners living in the country back to their home countries is B. Okay, so if foreigners are remitting back certain money from India to their home country, okay, so what it wants to say is that suppose this is India and these foreigners are remitting, they're sending back money from India. This money is going out from India to their parent country. Okay, so this will be B. This is B, what it wants to say. This money going out by foreigners. And incomes from citizens and businesses earned abroad. So if some money is coming to India, okay, this will be A. The money coming to India from the citizens and businesses which they have earned from abroad. So this gives the formula GNI is equals to GDP plus A minus B. This is the formula. Similarly, in case of GDP and GNP, what we have is that with two types of income that are different from those we used to calculate GNI. Okay, to calculate GNP, GDP is used again with two types of income that are different from that used in GNI. So these will be different. This A and B will not be used that we have used in case of GNI. In case of GNP, what we will do is that there will be C and D, another type of income. This will be different from the one that we have used in GNI. Income earned on all foreign assets, income earned on all foreign assets, and income earned by foreigners in the country. Income earned by foreigners in the country. So it will not take remittance. Please remember this. Here it is just talking about income earned on all the foreign assets, whatever be the income. And here income earned by foreigners in the country, it does not matter whether they have sent remittance or not. Because the case of GNP, gross national product, it is just concerned with how much the nationals of a country are making or they are earning. Nationals of a country. So if a foreigner is earning say 50,000 rupees and he's spending whole 50,000 rupees in India, then also it will not be considered a part of GNP because he is not national of a country. Okay, so here in GNP we'll just seeing the nationals. So the formula becomes GNP is equals to GDP plus C minus D. I hope this is clear. So these are the formulas. This will be clear to you. Okay. This is how you will have to do it. So there is a little difference in case of GNI, GDP and GNP. So in case of GNI, you have to take remittances also, which are there. Okay. And the investments which are coming. And here it will be only income earned from foreign assets and income earned by foreigners in the country. So now let us see nominal versus real GDP, what it is all about. So nominal GDP refers to GDP at current market prices. That is, GDP is calculated as per the market price for year for which GDP is calculated. So suppose what will happen is that, suppose this year shampoo is 100. Only one good is getting produced. Suppose, let us just understand for our understanding. Let us take a simple example. So suppose a rupees 100 shampoo was manufactured this year. So GDP of India for this year became 100. This is the nominal GDP. And if this shampoo became 110 rupees after 2 years, its price was increased. So the GDP of India will be 110. This will be the nominal GDP. Okay, so as the value of goods and services increase, the nominal GDP also increases. So there's no kind of any inflation adjustment. In case of nominal GDP, no inflation adjustment takes place. No inflation adjustment takes place. Please remember this, that no inflation adjustment will take place. Whatever be the value of goods and services at current market price, it is added and we calculate the nominal GDP. That's it. Now in case of real GDP, what will happen is that, okay, in case of real GDP, what will happen? Real GDP refers to GDP at base year prices. That is, GDP is calculated as per market prices in the base year. Thus, the real GDP negates the inflation in goods and services. So what it wants to say is that, suppose this shampoo was of rupees 100, say in 2010, and this is 2012, it became 110. Now, if I have taken 2010, please remember, please listen to this carefully, that if I have taken 2010 as my base year, 2010 as my base year. Okay, if I have taken 2010 as my base year, then even if the price has increased in 2012 to 110, but my real GDP will remain same. From 100, it will remain only 100. So in case of real GDP, you negate the inflation. You will just see that how many goods are getting produced, and you will see what was their price in base year. So for better understanding, let me give you another example so that it will be clear. Suppose now there are 3 shampoos in 2010. This is our base year. 3 shampoos were produced. 3 shampoos. Okay. So here, if each shampoo is costing rupees 100, so the GDP was how much? 300 rupees in 2010. Now come to 2012. If only 3 shampoos are getting produced, so even though their rate is rupees 110 in 2012, but for calculating GDP, we will take them as rupees 100. So again, the real GDP in 2012 was 300 only. So we have adjusted for inflation because we have taken the price as base price, and base price is taken the prices at the base year, and base year is decided by government. Okay, there's no fixed definition on which year you want to decide at base year, but it is decided by government which year is the base year. Okay, suppose if I have taken 2010 as base year. Now, but if something happens and there are 4 shampoos which are produced in the country now, instead of 3 in 2012, the capacity increased and 4 shampoos are now produced. So now the real GDP will become 400. But the nominal GDP will become how much? Nominal GDP will be 440. So this is the difference. In case of real GDP, you just take the prices at base year. So you are taking the prices as base year, and you're just seeing that how much is their price, how much is the total value of goods and services which are produced now at base price. How much is their value at base price, okay, which are produced in current year. So the current year is 2012. There are 4 shampoos produced. So their base price value is how much? Rupees 400. This is their base price value, that is rupees 400. This will be their value, rupees 400. Okay. This is how you calculate real GDP. You take a base year and you calculate GDP in any year with the help of base prices. So base prices are calculated at the prices which were there at the prices which are prevalent at the base year. In 2010, whatever the price was prevalent, that will be taken as base price. So even if the shampoo is produced in 2014, for the calculation of real GDP, will take the price of shampoo as rupees 100 only. Even if the market price is say rupees 150. But for the calculation of GDP, we'll be taking it as rupees 100 for calculation of real GDP. This is how it is calculated. I hope this is clear. So this is what a chart is there. Nominal versus real GDP, meaning nominal GDP is sum total of all economic output produced in a year valued at current market price. Please remember that this is current market price. Whatever be the current market price, it will be just taken. Sum total of economic output produced in a year valued at predetermined base market price. This was what I was saying. At a predetermined base market price. And base market price is the price at base year. So the price at base year is the base market price. Nominal GDP doesn't take inflation into account. So whatever be the value, we'll just take it. We'll not adjust it with inflation. So inflation is not adjusted. Inflation is not adjusted. Here inflation is adjusted. Real GDP is an inflation adjusted GDP. Current market price, base year's market price. Expressed in current market price, whatever is the current market price. Value of GDP is much higher since current market price changes are taken into effect, because inflation is generally positive in nature. So it is much higher. Value is much lower since market price of base year is taken into consideration. Okay, so real GDP is generally less than nominal GDP, except in the cases when there's a deflation in the economy. So generally you will see that nominal GDP is greater than real GDP. Except because generally all the economies have some kind of inflation. But if there's a deflation in the economy, then nominal GDP will be less than real GDP. So it may be asked in the examination that when can nominal GDP be less than real GDP in case of deflation. Uses can be compared with various quarters of a given year. This is its use, where it can be used. Can be compared with 2 or more financial years. Can be used to compare 2 or more financial years. These are the uses. So I hope this is clear, that the value of nominal GDP is generally higher than the real GDP. because of the inflation, due to inflation, and the value of nominal GDP is less than real GDP when there's a deflation. Now we have another thing, GDP deflator. What is its formula? So GDP deflator is nominal GDP divided by real GDP into 100. And this GDP deflator is used to calculate inflation in an economy. This is one of the measures to calculate inflation in an economy. And just remember this, in case of GDP deflator, it will use all the GDP, that is all the goods and services. Here, all of goods and services will be used. There is no basket of goods and services. All of the goods and services are used irrespectively. What I want to say is that suppose in year 2010, just for example, there was no tea present in India. No tea present. But in year 2012, tea came to India and now people started producing tea. People started consuming tea in India. So, in case of GDP deflator, you will have to take this 2012 GDP as it is. You will include this value of tea. Even though this was not present in 2010, it does not matter. You will have to include this tea. Even the goods which were not there previously are accounted in GDP deflator. So it takes total nominal GDP, whatever be the GDP in that year. Even if these products were not present in 2010, even if say tea was not present there, okay, or if say something like say video games were not present in 2010, but video games arrived in 2012, suppose. So you will calculate the GDP of 2012 by including both these products, that is tea and video game. And in 2010, even if they were not there, you will not include them. You will not include this because video games and tea were not there in 2010, but in 2012, video games and tea arrived at our economy. So the nominal GDP is the total GDP, not any goods, not any basket of goods and services. So please remember that in this case, it does not uses any basket. It does not uses any basket of goods and services. All of them are included. So includes all of goods and services. G and S I'm writing. Includes all of goods and services. Not any basket. It is not any basket is there. And then there's real GDP which was calculated. So I hope this is clear. So this is a way to measure inflation. GDP deflator is used to, even though its name is GDP deflator, but it is used for inflation calculation. So a little bit tricky here. Name is in GDP deflator, but is used to calculate inflation. All right. So I hope this is clear. So in next lecture, we'll be learning changes in GDP estimation, what has happened in India, trends in India's GDP, what is green GDP, and what is meant by economic recession. I hope this was clear to you. So very thank you for this lecture.